Hey everyone, this is Shai with you from VTrender. I get these questions a lot nowadays, and basic question is what exactly is order flow? Hopefully, over the next few minutes, we'll try to explain in short what exactly we mean by this term called order flow. Order flow is nothing but organizing time and sales data in a format which allows us to make relative comparisons between different stages the market is in. Okay, it is market generated information. It's popular as a tape reading the print. It is basically your candlesticks, your bar charts, your PNF charts, your Renko, whatever charts you use toggled open. When you open them and you look inside and you go beyond that open, high, low and close, the information you collect from the bar is what is called order flow. To understand order flow, you have to quickly understand what is an auction process. Okay, now assuming you are in the market, okay, and you have a position which you are entering. So let's say this is you in the market and you decided to enter a position. And let's assume for a minute you intend to be a buyer. You have a bias, which is on the plus side. You expect the market to go up. And let's also assume that you're trading in the Nifty futures and you decided to buy the Nifty futures at a price of about 10,800. Okay. Now what really happens every time you open a position, you open the position as a buyer, but after you buy, you become a seller, right? Or you're looking to sell into the market. So assuming you got a fill and you bought your Nifty futures at about 10,800, you have an objective in mind. You are obviously looking to offload that position or sell that position in at a profit. So in this case, let's just think that you have an objective in mind that is at about 10,830 and you're looking to take a profit at about 10,830. Price goes from 10,800 to about 10,830. You made about 30 points on your position, which is times 75. If you are trading only about one lot, you made about 2,200 rupees in profit that way. And that feeling is awesome, right? You get that wonderful feeling, when you are a winner, you won that day, you're in profit, you're jubilant. And it's a wonderful feeling, to have a trade, going right for you. But what can also happen is sometimes, things can go wrong. Yeah. So let's say, you had a 10,830 objective, which is a price target. You also had a stop loss in mind, knowing, that the market can go either way. And in this particular case, the stop loss, is about 10,770. Okay. You don't want price, to come to 10,770 because if it does hit 10,770 from 10,800, it would mean that your position is in a loss. And if a position goes into a loss, that feeling is not really good, right? You will be ending up, like this person over here, very angry, very upset, blowing a lot of steam out away. Okay, so this is a simple way of looking at order flow. You are a buyer. Okay, after you become a buyer, you try to sell. Okay, if the position works into a profit, you definitely feel victorious and you got your up estimate met, profit objective met, and you're in a profit. But it can also go into a loss, and when it goes into a loss, it is not a sweet feeling to have. The problem over here is there's not just one of you in the market. Okay, if you decided to enter a position at about 10,800, like you, there are about a lot many people who would have entered into the Nifty futures at that particular moment in time. Okay, let's put a number to these people. Let's assume the market was very liquid at that particular moment, and there are about 100,000 other people who are in the market along with you, all looking to buy into the market, all having a positive bias, expecting the market to go up. Okay, now they say in the market, when there is a buyer, there has to be a seller as well, right? So let's put some sellers also in the tape here, and they are taking the opposite position as yours. Okay, and they are looking for a negative bias. They're expecting the Nifty futures to go down, and they are wanting to sell into this market. Okay, now the whole crux is right here. Okay, for a minute, let's assume that there are about 130,000 sellers in the market at that point in time at 10,800. When the price is between those two prints at 10,800 buy side and sell side, there are 130,000 sellers compared to about 100,000 buyers. What do you think price is gonna do next? Is it gonna go up or it's gonna go down? Yeah, there's definitely more supply in the market, so price definitely has to move down, because there are about 30,000 more traders in the market at 10,800 who are waiting for a fill. Okay, so price is gonna move from 10,800 to about 10,799, where they will look to fill up 30,000 excess which is there at 10,800. If the 30,000 does not fill up at 10,799, price is gonna move to 10,795, 10,790, 785, 780, 775, and even 10,770. It's gonna continue probing downwards till all that 30,000 excess supply meets buyers. And if your stop loss is at 10,770, well, that's the way, okay, your stop loss is gonna be hit, and that's how, okay, your trade goes into loss. So there is a demand supply mismatch at 10,800. Price moves in the direction of the more aggressive player. In this case, there were sellers, 30,000 sellers who were more aggressive, so price moved downwards. This is a simple way to understand how order flow works. Okay, it's called reading the prints. It's a quick estimate of the buy side pressure and the sell side pressure at any point in time. To understand more about how we use order flow in our trading, head over to www.wetrender.com. A keen understanding of order flow is only understood well if you understand what an auction process is. So if you have a good base in market profile, you're going to be understanding order flow that much more better. Thank you for listening in. Have a nice